you think about the basic accounting equation, and you draw the giant T, can we see that there's a left and right side? So if you're confused, there's a little glimmer of hope that you get that. You know left and right. There's a left side of the T, there's a right side of the T. Perfect. What's the accounting term for left? What's the accounting term for right? Okay, see, it's not so bad. You know that. Now, here's where things get a little dicey. As I start making baby T's, cash, supplies, I'll stop there, but could I keep going? Yeah. I see more T's, baby T's. But you know what? They have a left and a right side, which means debit, credit, okay? So, that's not any harder than the big T. It's just that they're little baby T's underneath the asset umbrella. Okay. Assets are on the left side of the big T. So their left sides are what are called the normal balance sides, simply because these baby T's are on the left side of the big T. The normal balance side is also the side with the increase. Opposite of the normal balance side is a decrease. Debit's on the left, credit's on the right. An asset increasing is a debit. An asset decreasing is a credit. So then when we cross this big divide, the opposite is true for liabilities and equities. Okay? So, accounts payable. We still have a left side, we still have a right side. That means debit, we have a credit. Okay, that's easy. But now we've moved to the right side. So that's where the normal balance side is. We know normal balance sides are always the increase. We know opposite of the normal balance sides are always the decrease. An asset increasing is a credit. Excuse me, debit. An asset decreasing is a credit. The reverse is true for liabilities and equities when you get this and you get accounting. Okay, I'm starting to sound like a broken record, but it's all based on this big divide. If it's on the left side, it's a normal balance left. If it's on the right side, it's a normal balance right. If you have a debit, you have to have typically the debit's listed first. But if you pay cash for something, you know that's a credit. Well, then the other half of it has to be a debit. That's the beauty of it. Like, you might get half of it, then the other half's a freebie. If you know something's a debit, but are kind of fuzzy on what the credit is, at least you know it's a credit. Now, I could keep going. There's a couple normal accounts here. Capital and revenue behave like they should. We have two naughty accounts, which are what? Drawing and expenses. They actually increase on the debit side, because if we would put them on the credit side, that's making owner's equity go up. Well, when the owner takes money out of the business with the drawing, that would not make owner's equity go up. So they're naughty. They're not following the left and right rules. Left always means debit. Right always means credit. Does it always mean increase or decrease, though? No, it depends on what side of the big T you're on. Does debit for an asset always mean increase? Yes. You got to be careful on like a test question. A test question, which, by the way, I already took the test last night. Okay. The test might read something like, does debit always mean increase? No. Does a debit to an asset always mean increase? Yes. Don't associate debits and credits with increase and decrease. You could say, well, it depends on which side of the big T you're on. Here's a bigger question. Does a credit to an owner's equity always mean increase? No, because you have these two naughties in there. Okay. So in 3 to 4 minutes time, that's everything we learned yesterday. Does it help to hear it again? My goal with chapter 2 is this. By 3 weeks from now, you're painfully bored. Like you're pulling your hair out. Like, Mars, we got it. Like we got it last week. We got it the week before. Good. When I get you bored with the material, that means you get it. So my goal is boredom here, folks. I want you to just be like, she's still singing the song 3 weeks later. We know that debits mean left, credits mean right. I want boredom. I strive for boredom with this chapter simply because then you got it. Like you're just twiddling your thumbs like, let's take this test. We got it 2-3 weeks ago. Like I'll be doing a happy dance when you're sitting here bored. Because you get it. Let's start talking in the chapter, okay? You did these over the evening. Some of you sat here and did them until you got them done. Some of you were in here this morning doing them. That's awesome. Remember, my answer key is always a lot more detailed than probably what you were, and that's just okay. You'll notice I didn't grade your notes. I didn't grade this. Something is still up for grabs for that 5 points toward that test. The suspense lingers, right? So let's do question 1. Describe the parts of the T account. There are 3. That was one of the test questions. It might have been the practice test, though, too. There are 3 parts. Whoa, that's little. Can you guys even read that? Not at all? Is it on your computer still? Okay. Better? Okay. A T account has 3 parts, a title, a debit, and a credit. A T account is just like a tool that the accountants use. So there's the T. If I were making the cash T account, there'd be a title, there'd be a debit, and there'd be a credit. 3 parts to a T account. Number 2, the terms debit and credit mean increase and decrease respectively. Do you agree? Based on what we just talked about, I hope you wrote the answer is disagree. The terms debit and credit simply mean left and right. You could argue, well, depending on what side of the big T you're on, it may mean that. But just generally speaking, debits and credits do not necessarily mean increase and decrease. Number 3, Heath Precourt, a fellow student, contends that the double entry system means each transaction must be recorded twice. Is he correct? Another disagree. The double entry means that there's a dual effect on ALLO, meaning there's going to be at least 1 debit and 1 credit. I love this part of teaching accounting because it's very quick to identify one of them. Like students usually are like, oh, I know that's a debit. Well, then the other one has to be a credit. You just got to hunt for which account. Or I see a cash is going down. That's got to be a credit, so the other part of the transaction or the dual effect means it's got to be a debit somewhere. So you only have to be like half confident because the other part just naturally will come. It's just a matter of where. Number 4, Erica Mendez, a beginning accounting student, believes that debits balances are favorable, so in other words, good, and credit balances are unfavorable. Is she correct? No. Now, if we were talking assets, sure, she's correct, but she's talking in general. Erica is incorrect. A debit only means, a debit balance, so like an asset account, only means the debit exceeds the credit amounts. Conversely, this is just more wordy than I would like. Okay, debits aren't always a good thing, especially if that's on the right side of the T. Okay? If we're talking just assets, then yeah, the student would be correct. Number 5. State the rules of debit and credit as applied to assets, liabilities, and all of the owner's equity. Assets are increased by debits and decreased by credits. Because of this. Assets are on the left, so the normal balance side's on the left. That's where the plus is. Okay, liabilities are on the right. That's where the plus is. Opposite of that would be the minus. Now, is owner's equity a little bit dicey? Two of them act like that. Revenue and capital increase with credits, but expenses and drawing increase by debits. I'll call those the naughty counts. They do not follow owner's equity rules, but they can't. Because if you put a credit in drawing, that's going to make them go up, and that's not true. That's taking away from the business. 6, what's the normal balance side of the following accounts? So normal balance side is all based on, is it on the left side or is it on the right side? Is it on the debit side or the credit side of the big T? And that's what normal balance is. AR, I'd like you to write which type of account they are or the category. AR is an asset, which is a debit balance account. So it's on the left side of the big T. Left means debit. Cash is an asset that has a normal balance side of debit. Remember, normal balance side is typically what I'll mark with a star that always has the plus. Owner's drawing is actually an owner's equity naughty account. So it actually behaves like an asset. Accounts payable is a liability on the right side of the big T with a credit balance. Service revenue is an owner's equity account that does follow the correct rules. It's on the right side of the big T. Right in accounting means credit. F is actually an owner's equity account that's naughty. It takes away from the business when there's an expense. Think of it as asset's cousin. Owner's capital, I've got to slide my, scroll here. Owner's capital is an owner's equity account that does behave correctly. Okay, what's number 7 talking about? Indicate indicate whether each of the following accounts is an asset, a liability, or owner's equity, and its normal balance is debit or credit. So it's kind of like what we just did there. What do we have going on in number 8? It's harder to do it this way. Like when you make the giant T, it's way easier because you see the left and the right. To have to write it out like this is a little harder. Number 8, for each of the following transactions, indicate the debit and the account credited. So when you buy supplies, we're going to debit, or even if it would help you to put a plus by that, and credit accounts payable, putting a plus by that. How can you have 2 pluses? Because if I have supplies, I have a debit that increases, but I also have AP that increases. I bought supplies, but it goes up on what I owe them. The next one, I'm not even going to read it. Debit cash, credit notes payable. I would assume we got cash because we took out a notes payable loan. I see a debit, I see a credit. I got cash, but I also owe more now on my notes payable. The last one, debit salaries and wages expense and credit cash. Cash is going to go down when we're paying the salaries and wages expense. So I have a credit there. This one has to be a debit, which makes sense because cash is going down, salaries and wages are going up. But because that's a debit and this is technically a credit type rule follower, it's offsetting the overall owner's worth. Last one, number 9. Indicate whether the following accounts generally will have debit entries only, credit entries only, or both. I like this question a lot. Let me scroll. Why will you see cash having both debit and credit entries? Why will you see that? Does cash come in? Jenna. You can get money, the debit, or you can spend money, which is the credit. Very good. AR, kind of like what Jenna just got done talking about. ARs you own, they go up, but then when they pay their bill, they go down. Owner's drawing. Let's think about that a minute. Why are we only seeing debit entries there? Because they're taking money out. They don't ever like put money in with a drawing. If they put money in, it's capital. Okay, so owner's drawings typically will only be debits. Remember, they're naughty accounts. Accounts payable. Like accounts receivable, they're going to have both increases and decreases. When they happen, they're a credit. When we pay part of the bill or all of the bill, it's a debit. At this point, the naughty account, any expense will only have a debit balance. Later, you're going to learn that credit balances are what are called adjusting entries, but that's for a whole nother day, midwinter. So these two are naughty. Right now, you usually only see debits happening to offset the owner's equity's overall worth. Service revenue, you're going to learn later that we'll have debits to this. Service revenue is a credit only. When we sell stuff, it's a credit. Do you think customers ever return stuff though? They do, and then that's where things get a little bit messy. But that's again for another time. What do you think? Did it go okay? This is much harder to do than the giant T. So you have to really think about it. Let's do a couple together. Do you have brief exercises in your workbooks? I'm not sure if you do or not. Do you have brief exercises in your workbooks? Chapter 2-1. Do you have them in your workbook? So it would say brief exercise. Yeah, and we're trying to do 2-1 and 2-2. So you don't have them in your workbooks. So you'll put these in your notebooks. In your book, you'll find it on page 80. Yes. We're doing 2-1 and 2-2 for brief exercise. Yeah, that's a do it. What I'd like you to do in your notebook is set up, we're going to do 6 things, and we're going to title it here. Have a heading for account. Where's the debit? Where's the credit? Where's the normal balance side? Remember, normal balance side, and here's what I'd like you to put above that. I'd like you to put the ALO P in there. Normal balance side is where it falls on that vertical line, the big divide. I always like to star the normal balance side. The normal balance side will always have the increase. Opposite of the normal balance side will be a decrease always. Okay. Accounts payable. I'll let you finish. Sorry, you're still labeling. We're going to do these together. Okay. Accounts payable, put that one in first. Accounts payable is a liability. I'm looking over here. The liabilities are on the right side of the arrow. Right in terms of accounting means credit. So maybe put credit over here. That means that's where the increase happens. So the credit will increase. Opposite of that, of course, is the debit, and that will decrease. And you can put arrows, pluses, or minuses, whatever you would like to do. You don't have to write out increase and decrease. Now, the reason the credit was the increase is because it was on the right side of the big T. Right means credit, star, increase. Next account. Advertising expense is an OE that's naughty. Let's come over to the normal balance side. Normal balance side, it's under OE, but it's naughty. It doesn't follow the right rules. So it's actually a left or a debit-based account. So debit is where you will see the increase. Opposite of the normal balance side, in this case it's debit, will be the credit. Think of it as assets kind of evil cousin, because it offsets OE. If when we had an advertising expense and we'd credit it because it's under OE, it would actually make the worth go up, and that's not true. It makes it go down. Number 3, service revenue is an OE account that's a good one. Follows the rules. Money comes in because I sell something. OE is it's on the right side of the big T, so it's going to have a credit balance, meaning the credit is the increase, debit is the decrease. I want you to put a question mark by that debit right there. In the activity that you just got done doing, you don't really see service revenue debits ever. It's just money coming in. Let's think about this a minute. If we sell something and the credit service revenue, what's the debit? What are we getting when we sell something? Typically what asset? Cash, or what other one? If they don't pay for it right away. AR would be the debit. So cash or AR would be the debit. Number 4. Accounts receivable is an asset we can't touch, but it's the right to getting eventually paid. Assets are on the left side of the T, so the normal balance side would be left. In terms of accounting, left means debit. So every time an asset goes up, it's going to be a debit. Every time an asset goes down is a credit. Will you see this asset go up and down? It'll go up when a customer charges. It will go down when they pay their bill. Number 5, owner's capital is an OE account that's a rule follower, a good one. It's on the right side of the big T, so it's going to be a right side normal balance, which we know means credit. The credit will be the increase. Opposite will be the decrease. Last one. Owner's drawing, OE, that's bad, naughty. Not that it's bad. I mean, the owner can take money out any time. It's just it negatively impacts the allo. Okay, so although it's on the right, it doesn't follow the right rules. It doesn't follow the credit rules. It follows the debit rules. So the debit will be the increase. The credit will be the decrease. But kind of like before, I question if that's ever going to really happen. You don't really see credits under owner's drawing. For some of you, the light bulb maybe just went off. You're like, sweet, I finally get it. Or for some of you, you're bored, and I like that too, because it's just repetitively doing this. Let's do one more. We're going to do brief exercise 2-2. I think it might be right here. Okay. So on this one, it looks like it wants you to set it up by date. What are we debiting and what are we crediting? Very nice. I like this one. So we're going to list the date and we're going to debit and credit. Tomorrow, we're going to actually learn how to journalize this instead of just talking about it. Tomorrow, we're actually going to do what accountants do. Ooh, exciting. We're going to journalize. As we work through these transactions, it's dual effect accounting. So everything we look at will have a debit and have a credit. That doesn't mean we're journalizing it twice. We're just looking for the debit. We're looking for the credit. If we have one, we've got to have the other. June 1st, George Lynch invests $5,000 cash into a small welding business of which he is the sole proprietor. What is being debited? Cash. I'd like you to put plus 5,000 there as well. Owner's capital is also going up. Plus 5,000. So I've got a plus 5,000 under assets. I've got a plus 5,000 under owner's equity. A debit went up, a credit went up. Does the debit equal the credit right now? Number 2, purchased equipment on account for $2,100. What went up? Or I shouldn't have said it that way. What's the debit? What would we gain here? Equipment. So you're going to see that asset go up by $2,100. Oh, not $21,000. How did we pay for it? Was it cash? Let's take a pause. What would have happened if we would have paid cash? We'd have an asset go up and we'd have an asset go down. But we cross the big divide and we add a liability there. June 3rd, we paid cash, or excuse me, $800 cash is paid to landlord for June rent. What do we know is the credit this time? What went down? We actually are crediting cash, and cash is king to me. I always start with, if it's cash related, it's, okay, is it debited or credit? Going up or is it going down? Typically, I'll start with the debit, but in this case, cash is our credit of minus 800. Okay, and rent expense is actually debited for 800. I'm going to put a plus there, but remember it's a naughty account that's actually making owner's equity go down. Last one. We send a bill to M. Rodero for $300 for welding work performed on account. So we have a welding business. Did we sell something? If someone, we sold some welding services. Okay. Did this Rodero guy pay cash, or did he charge it? He charged it. Now, had he paid cash, cash would be the debit. What's our debit? How did he pay? Accounts receivable went up by $300. Service revenue went up by $300 as well. Would we have loved to have seen a cash there as a plus 300? Yeah. What's going to happen eventually? Eventually, this AR is going to be credited and what's going to be debited instead? Cash, because eventually he'll pay his bill, minimizing AR. Well, there you have it. We're way ahead of schedule, which is okay. I'm going to play the debit and credit wrap for you one more time because we need that in our life as much as possible. And then I just want to review, but I'll start lecturing on the next section because it's going to take like the rest of the week to do anyway. So I'm going to stop this recording.